So I'll be taking IFRS 16 today, accounting for leases. So I know some of us might be aware of leases. Some of us must have known what is called lease and what a lease is about. So, but I'll be delving into this to explain further as we go on. So my next slide, that takes me to my next slide, which talks about table of content. I'll be defining and explaining the scope of leases. I'll give you what is the difference between a leasing and a lessor accounting, as well as the accounting and the definitions. I'll explain what right of use asset is. I'll explain what a sales leaseback transactions are. I'll explain a short-term and low-value exemptions in terms of lease and disclosure. With respect to number 5, if you check my LinkedIn profile, I've written a very good note on it before. I think sometimes in July or August this year, about short-term and low-value lease. I wrote a sort of write-up about it and the lease. So any question you have about lease, please do ask me because I'm a lease expert. I do lease as part of my job almost every day. So what is a lease? So basically, a lease is a contract or part of a contract that conveys the right to use an underlying asset for a period of time in exchange for consideration. So if you are trying to use an asset, for example, you're buying, let's say, a you're buying, let's say, a bus, a big bus, and you want to use that bus for a period of time. In so over here in the UK, we use lease a lot. In Nigeria, it might not be popular. People might not be using lease so much. I don't know if people use lease so much, but over here in the UK, we use lease a lot. So almost everything we do is lease. In fact, I'll tell you, my car I'm driving is on lease. So I drive my car on lease. Everything we do is on lease. So you do things on lease over here in the UK very regularly. So you get the assets and go into a contract. That's what lease defines. I'm just giving in a layman term. You go into a contract, get the assets in advance. You're using the assets, and then you're paying for the use of that assets. So that is a lease. So now, for every lease, you have to consider two tests in terms of the control. There are control tests which you have to look out for in every lease. So a customer controls the use of an identified asset if it has two things. One, if the right to substantially all economic benefit from the asset, if that right is there, then that asset, the person has control over the asset because lease is an asset. Don't forget. So because it's an asset, don't forget it's an asset. You're buying a bus is an asset. The fact that you're paying for it means it's an asset because leases are not like 2 month, 3 month. They're like maybe 6 years, 10 years, 12 years, and so on and so forth. So it's an asset. So the moment you have the right to, so you have to look at those two things before you can say this. Before you can class something as an asset in your book, you have to look at two things. What are those things? Do you have the right to direct the use of the assets? That second, it says the right to direct how and for what purpose the asset is used. So, for example, my car now, I can say that, oh, I'm not driving my car today. I want it to be in my house. I can say, oh, I want to take the car to, let's say, Scotland or Wales or Northern Ireland, and then I want to drive it down there and stay there for like 6 months. Nobody's going to ask me a question. Then it means I can direct the use of the asset. I can say, okay, um, can I use this car? I might try to say I want to use this car to carry my wife to work, to go to my place of work, go to work and coming back, can I use it to generate, like, can I get economic benefit from it instead of me going to take a bus or go to a train station, because I had to use the my car to go to work. So which means I'm generating economic benefit. It makes me go to my client site on time and all of those. So then I'm actually generating what is called economic benefit. So those two things are actually what you have to look at for. You can say, okay, this thing is a lease. Oh no, this is not a lease. Sorry, this is an asset. Oh no, it's not an asset, not a lease now. But you are looking at the area of an asset because don't forget a lease is an asset. Because the fact that you're paying for it in a long time is an asset. So because when you pay for it in a long time, then that's to go on your book. As I'm going to come to that, I don't want to jump the gun. So it comes to your book as right of use. I don't want to mention right of use, but let me just mention it. So that is how you know if it's an asset or not. So example of assets under lease. So example of assets we can call that we have like buildings, we have vehicles, like I mentioned, the car, long vehicle, lorry, depends, any machineries, then office equipment that are, substantially of huge amounts, not just huge amount, but not below $5,000 in terms of in line with the IFRS standard. I'm going to come to that later. Let's just go on. So I hope you understand up to this point where I am. Please, if you understand, just respond that you understand. So I'll go on. So so definition. So who is a leaser? So a leaser is an entity providing the right to use the asset. I'm just trying to give concept around definitions for now before I then go into proper accounting of it. So a lessor is an entity that is providing the right to use the assets and receive consideration. So what is that consideration? It can be benefit in kind, it could be cash, it could be I forgive your debt, or I forgive your pardon, I pardon you, or I'm not going to leak this secret if you allow me use it as a, and they go into a lease agreement. So the consideration can be monetary and it might not be monetary. So, but as long as the person receives a consideration and then they are providing the asset to you, then they are the lessor. So, which means we know that the lessor is who provides the asset. So now the lessee is the entity that obtained the right to use the asset and pays consideration. Like I said, it could be any consideration. So the lessor is me. If I go to get a car now, for example, if I go to get a car on lease, so me that gets the car, I'm the lessee, right? While the person who provides the car to me is the lessor. Don't forget that the lender becomes the lessor, the borrower becomes the lessee. So don't forget that. So right of use of an asset. So lease's right to use an underlying asset during the term of the lease is just what the right of use is, which means you're talking about that for you to recognize this as an asset, you are saying, okay, I have the right of use of this asset. That's what you're just saying. It's not saying that is your asset. Can you see before now IS 17, which we have before. We know before we have IS 17, now it's IFRS 16 used to use just assets, but then they look at that and say, no, it doesn't make sense because this asset is not yet yours. So what you have is just a right to use the asset. So therefore, you can class it as your asset, but it is a right to use the asset, not your asset. So you cannot say assets in your book. No, it is wrong. So we now use the word right of use. So if you go into um these proper lease account. I'm going to show you practical example. Don't worry. I'm going to show you a live data which I did. The lease I did for company in a company in, I think Sweden or which country I can't remember. I did a bridging. So I'm going to show you. I'm going to also show you practicals that you understand lease when we are done. You understand lease. Don't worry. So the right of use is saying that I have this right to use this asset, not that I'm the owner of the asset. So is this right to use the assets during the lease term? You can see it must be during the lease term. So it means that once you go, if the lease is 15 years and you are leaving that lease, then you need to know that once it is over 15 years, that you cannot use that asset again after that time. So which means you cannot recognize the right of use of the asset again after that time, except if the lease is then transferred, to become your asset. That is, it becomes like a finance lease, a full finance lease for the covering the full years of the asset. I want to go to the next slide. So what are types of lease? We have two types of lease. We have a finance lease and we have an operating lease. A finance lease substantially transfers all risk and reward of ownership to the lessee. That's what it does basically. It transfers all the risk and rewards to the lessee. While an operating lease does not transfer substantially all the risk and reward, the landlord still keeps from some lease. For example, if I go lease a house, for example, I was yes, please. So I was going to lease a property sometime lease a property for 125 years. So that property that I want to lease at the time, the landlord say I'll be paying ground rent, I'll be paying this. Then the landlord say I cannot use the garden to do what I want. That means they don't transfer all the risk and rewards to me in that property. It's just an operating lease. Do you get? They are not giving me all the risk and reward. And again, that property cannot there are many things you look at for when you're looking at operating lease. I might not have written them here, but let me mention them because I'll just also mention to you practically based on what I do. An operating lease, for example, is you look at some considerations which are one. You look at the fact that how long will this lease is this even property valued? If the property is valued for let's say 200,000 pounds or naira, and then the lease value everything is about 180,000 naira. Do you know that that lease can be referred to as what as a finance lease because you are basically virtually using almost all the life of the assets. So risk, which means reward should be transferred to you on that asset. Then also, if you look at the lease, that okay, this lease, if the lease was like let's say 200,000 naira, and then you decide to do a lease of within a period of let's say 50,000 naira, then which means that lease can never become a finance lease because you have not even paid for all the lease. Do you get of that? So which means there will still be some useful life left on that lease, which you have to return back to the owner of the asset. So those are the kind of things you look out for in lease. And also you look out for the things like maybe the rewards that have been transferred, the rights that have been transferred, are they fully transferred to you or are they not fully transferred to you? So indicators of a finance lease. So you look at one ownership transfer at end of lease. So you can see in a finance lease, ownership transfers to you at the end of the lease. So which means you've actually used almost all the useful life of the asset, or you agree to do a PCP, like a PCP, call it PCP year, whereby you pay for owning the lease, and then at the end of the lease, you pay a particular amount to close out that lease, or maybe like an hire purchase, whereby you are using the lease, you are using it for a period of time, and then at the end of the period, you just take it off. It becomes your own, but you're not paying any lump sum. So different between PCP and hire purchase is that PCP you pay some lump sum. Let's say if the total value is 10,000 and you use 10,000 at the end of the PCP, they might say the contract might say you'll be paying £2,000 to them. So, which at the end of the contract, so which means at the end of the contract, you have to pay £2,000 to them. But it's a purchase, you are not doing that. You're only paying your £10,000 at the end. That is all you own the asset. So something like that. So you have a bargain purchase option also. If you have a bargain, if there's a right or an option to bargain purchase the asset, for example, it might start off as a operating lease initially, but then you then say, "Oh, I love this property, I love this business, I love this property, I want to buy it." Then they give you an option that in case in the contract it will state that in case should the leasee need to keep the assets, there's an option to purchase this asset, then it can be classified as what a finance lease, because you have a right, you have an option to purchase if you want. So also lease term covers major, you can say I talked about this before, major part of economy life. If the asset is 20 to 20 years, you've used 19 years or 18 years, then it's a finance lease already, because the asset will be useless to the owners if you return it back to them. So that is why, or it is 200,000 you've used like 190K in the asset, so which is nothing left. Also, the present value of the lease payment is more like the fair value of the asset. It's almost like it's not really equal to, like I mentioned. I mentioned 200,000 and you've used like 190,000 of the life of the lease. Then it means equally you've used is a finance lease, it's not an operating lease. Because if the lease is 200,000, if it costs 200,000 and then you spend 190K, I'm going to show you examples of this. Then it means is you've used almost all the life of the asset. And also, if the asset is specialized, for example, if the landlord or the lessor bought tractor, or let's say a part of a ship compartment or a cruise ship that is only specific to your own ship alone, you cannot say you want to make it an operating lease, because who will use it? Where will they use it in? It has become a specialized asset, so it cannot be used by any other person or by anybody anywhere. So it has to be used only solely by you. So therefore, it becomes what a finance lease. Also, if the leasee bears cancellation losses, so if the leasee is going to bear a loss to cancel the assets, the lease, then why would I want to cancel the lease? I'll just keep using the lease until I know that yes, especially when the cancellation cost is high. So that is why you just keep using it. For example, I talked about a property that I was going to buy one time. To cancel that lease property, there's going to be a high cost for me. So when I realized that, I decided not to go into that lease at all, because I realized that it's not going to be favorable to me. So if the cancellation cost is high, then you don't want to go into it, or you don't want to cancel the lease. You want to just keep using the lease, and it becomes what a finance lease. And also, if the leases benefit from residual value changes, if there are benefits that changes, for example, if the residual value is probably before was like you bought the amount of the PV of the lease was like maybe the cost of the lease is like maybe 200,000, and then the PV of the lease is about 120,000 before. And then after you use that lease to that time, you decide that okay, I want to use the lease longer for like another 4 years, and that became like maybe 190,000. You've used almost the useful life of the asset, and then the residual value of the lease has not even dropped, either by two things. One, maybe by the use of the assets, maybe the asset deteriorated faster than you expected, or secondly, the assets deteriorated based on the time of use of useful life that you use the asset. Then in that case, you can decide to the lease becomes a finance lease, because if you've used most of the life of the asset and the residual value has reduced to like almost new, or change and reduced so much, then you benefit to own the lease in full. I don't know if you get all of this, please, if you understand me so far. I tried to explain it so much, so it will be very simple. Please let me know if you understand me so far, please, before I move on. Okay. All right, so commencement, the leasing recognizes the right of use of the asset. They only have right, like I said, they only have rights to use the asset, but they don't own the asset at the time. and they also recognize a lease liability. Then a lease also recognize a lease liability, which is the same thing as the present value of the future lease payments. Because we're going to be doing discounting, we'll discount it using the PV. This normal our finance PV nonsense. We use parent value to discount it to know what the value is, the future value is at now. Sorry, because we only have the future value. We need to know what the value is going to be as at today. So the lease payments would also include fixed payments or variable payments based on the index and interest rates, expected residual guarantees, purchase option, if reasonably certain, if it's not a finance lease, if it's like a normal operating lease, then you have purchase option. Then termination penalties, if you want to terminate unexpectedly, there are going to be conditions that are meant to hold you strictly from terminating the lease. All right, so that is the initial recognition. So I'm going to go to subsequent measurements now. So before then, I have an example to give you. So the example is this. I said now example one. So example one, ABC Limited leases equipment for 3 years, paying 10,000 naira annually in arrears. The discount rate is 5%. So we are required to compute initial lease liability. So who can tell me what's the initial lease liability? I've already done it already for you. I've done the PV for you already, which you can see on the screen. So the lease, ABC Limited leases equipment for 3 years, okay? Paying 10,000 naira annually in arrears. Don't forget in arrears. In lease, it's very important to in arrears and in advance can mess up your lease. You get in arrears and in advance can mess up your lease. So discount rate is 5%. I was in a lease sometimes in 2 months ago, and that lease, I was in a lease sometimes 2 months ago, and that lease, I was treating that lease in arrears instead of in advance. I did not know. And not doing that, I realized that my lease was not balancing. I was struggling with it, only to now check that they pay in advance and not in arrears. And I had to go and change my calculation back, then everything balanced. So it's very, very important to note that. So first thing you want to do, you want to look at the solution to this. I'm going to do this one for you so you can see. Is that you first calculate the present value. The present value of that lease. They say that they're going to pay 10,000 every year. So I'm going to do what is called a discount factor. They've given me the discount rate, which is 5%, and I have the number of years. So I'm going to say my 10,000 is going to be it's going to be my what? It's going to say, I say 10,000 times 1 plus 1, 1 minus 1 plus r raised to power minus 3. So what I've done is I've done what is called, what do we call it in finance? Please, you guys remind me, what's this thing called? I've done what is called, um, I didn't do the discount factor one by one. Normally, I could have been doing 1 year, year two, year three, and arrive at the same answer. But what do we call this when we do it like we do the total everything at once? Like if you're having 15 years, you do the 15 years at once. This is the formula to do it at once. So it's basically the value times 1 minus 1 plus r raised to power minus 3 divided by what? Divided by the discount rate. So then when you do that, you're going to get the discount rate as 2.7 to 2.723. If you multiply that by 10,000, that means in 3 years' time, that value today that you're supposed to pay, you're supposed to collect 30,000. But I'm not saying that due to the rate of inflation and rate of in 3 years' time, we expect that value is just 27,000 to take, not 30,000 that you're collecting in 3 years' time, because that is the value today. Due to that, the money is going to reduce, the money does not increase. If inflation is high, then the money can. If the inflation is low, then the money will definitely increase, but it rarely increases because obviously inflation keeps going up. I don't know if you get the concept of discount factor. I don't want to go, or should I go into discount factor to explain it to us? Should I go to discount factor? Okay, now when you talk about discount factor, now the discount rate of 5% is an element of inflation. I'll be clear with that. Now, if discount rate is 0%, it means that there will not be any inflation we are forecasting that there are no inflation in the economy, which means in 3 years' time it will be 30,000. Do you get that will be having as our value? If discount rate is 1%, it means that inflation is at 1%. In 3 years' time, it will be about 29,000 something that will be. But because discount rate here is 5% based on interest rates, as of today in the country, then we can confidently say, okay, in the next 3 years, we forecast that it's going to be 27,230 based on our discount factor and our which is our inflation rate. But if it's a country like Nigeria, where you have interest rates and inflation to be like 20 something percent, 21%, 27%, 18%, then your discount factor will be based on the interest rate in the country. I know in Nigeria, interest rate should be about 20 something percent, or 20% or 15%. So if it's 18% thereabout, then you have to use that percentage as your discount rate, which means you are telling me that in the next 3 years you'll be poorer. Because if you use 18%, it means that at the 30,000 you are collecting today, that you are collecting today, you are thinking is going to be, you'll be paid today for it. They're going to be paid in 3 years, sorry. It means that in the next 3 years, you are poorer, you think you are richer. Because 30,000, if we bring it to present value today, it will be like 18,000 pounds, 18,000 naira. Do you get? So discount factor and PV looks at what will this money be in 3 years' time. I'm going to get this money in 3 years' time, right? But the 3 years' time money I'm going to be getting, I want to bring it to today to see what is actually that value of that money. So the value of the money today is 27,000. But if it is in Nigeria, you're using 18% or 20% interest rates, the value of the money will be about 15,000 or 12,000 naira because of what the inflation rate in Nigeria is very, very high. I don't know if that is very clear. If you got that. Please let's respond quick so I can move on. I have a lot to cover today. Okay. I'm I'm using a second. Can you hear me? Can you guys hear me? Can you all hear me, please? Okay. Is it just one person? Am I breaking for one person or everybody I'm breaking also? Am I breaking? Sandra, am I breaking? Am I breaking? Eh? Okay. Sandra, am I breaking? Hmm? Hello? Sandra, am I breaking? Samuel, am I breaking? Okay. So Mr. Opele is your internet then. I just want to be sure of that. All right. So now, okay. Okay, go on. The views and the cost, what do you mean? Recording, sorry. And when you don't do this, you don't do what you do, what you debit right of use asset, which is your non-current asset, then you credit what the lease liability for the same value. Then that is initial recognition. Then what do we do in subsequent measurements of the assets? So subsequently, what we then do is that we will recognize the interest elements and other balance sheet items. So subsequent measurement treatment is that at the end of year one, the interest will now be 27,230 times 5, give you 1,362 as your interest for year one, right? Then the payments will be, don't forget that the payments in our question was 10,000 per year, right? So you are paying 10,000 every year, right? The lease liability after the payment will then be 27,000 base, which is your PV, 27,000 plus the interest you are paying, then minus the amount you paid that year. Is that clear? Don't be confused. Don't forget that your lease payment is 10,000 per year, which you're going to be doing what? Debit what? Bank, sorry, credit bank, Abi, and debit what? Hmm? Credit bank and debit what? The journal is in our front now. Credit bank and debit what? Lease liability and interest expense. That's what we are debiting. So once you are crediting cash or bank for that 10,000, so as you're crediting cash or bank, because you're reducing your bank account, then you also have to reduce your liability because your lease liability you recognized before was what? Was 27,230. You have to recognize that liability by doing credit bank of 10,000, then debit lease liability of 8,000, 8,638. You have to debit lease liability for that amount. Then your interest, don't forget that because you have done some discount factor before. So you now have to now go and debit your expense, right? You have to debit your expense for what? Your interest expense, which is that 136 for what? For 1,362. That's why we did 27,000 plus 1,362 minus 10,000, which means your lease liability will now be 18,000 for that year. Then The depreciation of right of use asset, of course, obviously we have 27,230 right of use. Don't forget at this stage, don't forget at this point that we had 20, right of use assets, we had 27,230, right, at this time. So what we then did was that we then did 27,230 divided by 3 years. So we then know how much it goes to our assets every year. Don't worry, I'm going to show you in Excel how this is done. So then we now have 9,077 naira that goes to our right of use every year on a yearly basis. So in 3 years, we're going to come back to that 27,230 and subsequently measured. Is that clear? All right, so I move on to the next thing. So, statement of financial position. So, what is the impact of this presentation in the both the balance sheet and the impact is that one in the balance sheet, the right of use assets is always under non-current assets. That's where you find it. Right of use assets because it's usually leases are not 1 year. The moment you have a lease that is 1 year, which is 12 months lease, I'm going to come to that later. Then it is not a lease. It is not a lease that should be recognized in line with IFRS 16. So the moment you have a lease that is 12 months, you must not recognize IFRS 16. You have to then recognize the lease as an in the P&L as an off-balance sheet item. I'm going to come to off-balance sheet item later. So then that's so because the lease is more than 1 year, so it will always be your non-current liability, your non-current assets. And also you recognize the lease liability in your P&L, which is a split between the current and the non-current liability. So for example, in that example I gave, you have the current let me go back to that example, the current liability, which is going to be what? 8,638, which is your first payment for that year. Then your non-current liability will now be what? Will now be 18,592. Because don't forget that your current liability will usually be what you're paying that year, while your non-current liability will be what you're paying in the next 2 to 3 years. So that is why we have a split between the current liability and the non-current liability. Then on the P and when I'm because I have a lot to cover, please. Thank you, sir. So I talked about lease liability split between current and non-current. Hope you understand what I now mean now. So the right of use asset also non-current and non-current, but you don't split that within current and non-current, but you split this because the liability of current and non-current. Then also in P and L we have depreciation, which is the operating expense, and then the interest expense, which I'm going to be explaining to you further as we go down the line. So now, IFRS 16, we are now going to move to sales lease back. We are done with lease for leasing now. I'm going to go to sales lease back. So for sales lease back, what is sales lease back? Sales lease back is this occurs when an entity. I'm going to try to move fast on this storytelling, please. You can read the storytelling yourself. I want to go to calculation. Of course, when an entity sells an asset and leases it back from the buyer. So the parties involved in a sales lease back is the seller leasee. Now, don't be confused. When you hear the seller lease, what comes to your mind? Mr. Moefe, Isela Lizzie, what comes to your mind? Mr. Moefe, are you here? Or you are not with us. Isela Lizzie. Mm. Okay, so it's when you hear the word seller Lizzie, this can only apply when you're doing a sales lease back. That's what I want to just establish because it's a confusing term. It can only apply when you're doing a sales lease back. I want to just clear that because you have that confusion when you hear the word seller lazy, buyer lazy, it does not make sense. It looks like you are contradicting yourself because normally we should be having seller lazy and buyer lazy, isn't it? But now we're having seller lazy because it is a sales lease back. It occurs when an entity sells an asset and then leases it back from the buyer. Do you get as a sales lease back? When people decide to sell an asset to you, for example, I can sell you an asset now, let's say a car, and then because I wanted that cash for something urgently, and then when I got the cash, I did what I want to do, and I got my profit back on what I want to do. And I say, please, one name, I want to buy this car back from you. Oh. Please, will you sell this car back to me? Oh yeah, no problem. I'll buy the car back from you. So that would have been in the agreement from beginning. Do you get? That is when it's a sales lease back. In the agreement, you'll have had agreement that I'm going to sell this car to you. I'm going to lease this agreement back from you. I'm going to lease this sales for this car back from you. So do you get what I mean? So that I can try to sell a car to you, Mr. Moefe, for 50,000 naira. If I sell the car to you for 50,000 naira, then I decide to now lease that car back from you because I need that cash. That cash is tied down in my car, and I want to do some business, but I need that cash, and I also need that car. So what I'll do is I sell the car to you for 50,000 naira. You give me 50,000 naira, then I now still lease the car back from you for 5 years. I'll be paying you 10,000 per year. Do you get? So from that 50,000 naira, now I'll be paying you 10,000 ahead. You'll be giving me 40,000 naira. 40,000 naira cash is with me, but the car is still with me. Do you understand that concept now? Do you get the concept? I sell the car to you, and I'm leasing the car back from you. Exactly. uh So now the seller leasing is the entity that sells the asset initially and then leases it back. That's why they call him a leasee. Normally, he's supposed to be a seller leaser, but now he's a seller leasee because he has sold the assets and he has leased it back from you. So it is both the seller and it is also the leasee. Do you get? While the buyer leaser is the entity that buys the assets from the seller. Do you get? And then leases it out again to the seller who initially sold the asset to him. So it is both the buyer and the leaser of the assets. Do you get? So that is how that works. So how do you assess a sales lease back? There are different steps to assess a sales lease back. Number one, assess whether the transfer is a sales or not, which means you have to apply what is called IFRS 15 concept to it. To you want to know if it is actually a sales or is not a sales lease back. How do you know? You want to know if the buyer obtains control. So you want to know who bought the asset? Did he even get control at all? For example, now if I said I sold an asset to you, if I sold my car to Mr. Moefe, like I made the example of 50,000 naira, and then I didn't give him paper of the document of the car. I did not even drive the car to his house and let him and give him all the keys and change the name of the asset to him. And I'm saying that, oh, I sold this car to you, yeah, give me 50,000 and I pay 10,000 every month. Please, is that a sales lease back? I mean, like, can you respond? Is that a sales lease back? Is that a sales lease back? And I wasn't listening. That she said, yes, I got it. Is that because the assets was never given to the person initially, right? Yes, but the moment the asset is given to the person initially, then it becomes a sales lease back because you've then sold the asset. Then the person now decides to say, okay, now that you sold the asset to me, I'll now give you one key out of the four keys. Do you get? And then lease it to you. Not as if you are the seller, you still have the four keys. I'm not saying that I've sold the car to you, but lease it back to me. And there's the seller has no control, he has no key, he has no document, he cannot say what you get, then it is not a sales lease back. Then, if not, it is a loan arrangement. Can you see that now? Because the moment I don't have control over that car, then I've only just loaned you. I've only loaned you 50,000, 40,000 naira. Do you get? And not leasing you, not you not sold your car to me. That's what covers it. Because if it was not a loan, if it was a lease, you should have transferred the document title to my name, to Mr. Omoefe. Then I should have also transferred giving him all the keys to the car, the particulars to the car. Then by himself, he will now say, okay, now that you want to lease it back to Moses, then okay, Moses, take one key out of these four keys. Document is still carrying my name, but I'm leasing it back to you. Do you get? That's why it sales lease back. But if it's not, then it's a loan arrangement. So treatment. What is the treatment when it is not a sales lease back? If it's not a sales, then the seller leasee continues to recognize the asset because after all, he hasn't sold the asset. So you get, then he continues to recognize the asset. Then he also recognize financial liability for proceeds received. So the proceeds received is now a loan and not a sales. So therefore, the buyer leasee recognizes financial assets as a loan. Don't forget the buyer lessor. The buyer lessor is who? The buyer lessor is the person who bought the asset and also leasing the asset back. Because he has not leased the asset back, it's a loan, it's not a full lease. So we have to do what? Debit cash and credit what? Financial liability as a lease. Do you get? Not lease liability. Because it's not a lease, it's a financial liability of that loan. I don't know if that is clear. What we got was a loan and not a lease. So we have to recognize what's called financial liability for the lease. So I'm going to move forward now. So when assessing when a sales lease back has continued, so treatment when the transfer is a sales. If it is a sales, whereas that okay, done we've transferred control and rights and everything to the person who we sold the asset to. But we are now leasing it back from the person. The person gives us one key out of 4 key, name is still in his hand. He has control. He can try to come and take that thing from us if we breach the contract and agreement of the lease. Then what the seller lease has to do, that's the person who sold the asset initially, who is now the lessee now, will then recognize the asset from his book. He cannot recognize that asset in his book again. Then he will recognize the right of use assets, which is proportionate to rights retained, as we did before. Right of use asset, you must do your PV, present value, and discount it to get your present value. Recognize your right of use assets. Then you recognize gain or loss only on rights transferred. So buyer lessor will then do what? Buyer lessor will then recognize what? The assets under IAS 16. Don't forget that the buyer lessor is who? The person who bought the assets, but then what? Leased the asset to what? To the seller lessee. So now it's not the new lessor. Do you get? While the seller before, it was not the lessee now. So if we recognize assets under IAS 16, because the asset is now his asset, don't forget. I hope you're not getting it twisted that now if I sold asset to Mr. Moefe, the moment I'm selling the asset to him and I'm leasing it back, when I'm selling the asset to Mr. Moefe recognizes that asset as an asset under IAS 16 PPE. You thought PPE, right? He recognizes asset in his book as I own this asset, not a lease. Because don't forget I sold the asset to him. Then, if you now want to lease asset back to me, right? He will then lease asset back to me, but it is in his book as an asset. Why? Me in my own book, I'll be recognizing right of use assets because I'm not leasing the asset back now. Do you get? Then why he will now account for lease in his book as a lessor? Is that clear? Okay. So we go to the next thing. So an example now. I want Sandra to answer this question for me. So Sandra, over to you. And example two. An entity sells equipment carrying amount is 500,000 naira. The fair value is 600,000 naira and leases it back for 5 years. The PV of the lease payment is 450,000 naira. What is going to be the calculation for this? Sandra, can you answer, please? Sandra is running from this list class, so can anyone try? Okay, no problem. No problem. So who else can try? Who wants to try? Aminat, Mr. Moife, Adejoke, do you want to try? Mr. Upele, who wants to try? Who wants to try? Let me give the answer. So the step one is to do what? To portion the right of use. Now, don't forget that because the asset is having a carrying amount. I know nobody will be able to get it because it's a bit complex. Is that, but I expect the child accountant should be able to get it in the room. So carrying amount is 500,000 naira, while the fair value is 600,000 naira, right? But however, the lease payments for the PV of the lease payment, that's the PV of the present value of the assets of the based on your PV we've done is 450,000. And don't forget that the PV, I didn't want us to start calculating it again. That's the PV I've done here is that same calculation I've done, which is the asset value times bracket one minus bracket one plus r raised to power minus number of years. Do you get divided by what? Divided by the discount rates, right? I've used that to get what? Do you want me to go back to show you that calculation again? This this initial calculation which I showed you here, which is asset value times one minus bracket one plus r raised to power minus n divided by discount rates, right? That's what I've got. So that 27,003 230 I got here is the same calculation I did to get that for 50,000. So I didn't just want to show that to us. So now, having got that, so what we then need to do is we then say because the fair value of the asset is 600,000 and not 500,000, which they are carrying in their book. Don't forget that the equipment fair value is 600, but they are carrying the book as 500,000 in their book. We cannot use that. What we then need to do is we then need to say 450,000 divided by 600,000 to get the portion of the retained right of the fair value. Then that will give us 75% of the right of use to recognize. Do you get? Then the right of, I know it get complex when it's a sales list back. Even me too in the exam, I don't understand. I just cram and go and write exam and I pass. So if you want to cram and know it now in case you're going for an exam. So yes, because sales list back is always a bit complex. It's always like this in the exam, or it's always like this in ACC, AC is always like this, the exam. More. So then the right of use is now what 75% times the I'm carrying the amount which you are carrying in your book. Do you get that concept? Now we are saying that the carrying amount is what? I have a formula for this which I can give you. Ah, I will give you later in the group. I have a formula I used to use for this. So 500,000 is the carrying amount. The fair value of the asset is 600,000 naira. Don't forget that that fair value of the asset is what the asset really is, not what the carrying value of the asset is. So is it in an exam more? You're saying carrying amount, so amount, fair value, so amount. Please ignore the carrying amount for now. When you're trying to get the portion that you want to apportion for right of use, you need to use the fair value because the fair value is the real amount, not the carrying amount. The carrying amount might be higher than the fair value. So the fair value is the right figure that you can sell it in a what? In a market at arm's length, right? In a level two observable market in line with IS what? IS 30 what? IFRS 7, IFRS 13 that you taught last week, fair value. So now you now do 450 divided by 600,000, then we'll give you some 5%. Then 5% is what you're going to recognize in your right of use book. That's 5% times what they've carried that asset as. Then you now recognize what? 375,000. Then the gain on the sales, don't forget that there's a gain on that sales because the gain is supposed to be 25,000 because we say 600,000 minus 500,000, which is the amount of the asset 500,000, which is the fair value minus. Let me see if let me bring up that formula for you guys, please, so you don't get confused. Let me bring it up so that you don't get confused. So, short term low value. This is also a very good one, which I like. It's very easy and straightforward. So we have some assets that are like short-term assets. They are like short-term and they are low-value assets. So according to IFRS 16, basis of conclusion 100 is not here. I'm quoting from my head. According to IFRS 16, basis of conclusion 100, it states that assets can have a low value, and then the asset can also be short-term asset. That also assets should not be recognized. There's an exemption to not recognize this asset as lease in your book, so you can treat those assets as what as an off-balance sheet item. When I mean off-balance sheet item, I mean that you are treating them in what in your P&L alone, and they're not going to come in by your balance sheet. I'll explain for that what that means. So leases, it says leases may elect not to, sorry, I use accounting estimate there. I didn't change the heading as in the template. Leases may elect not to recognize right of use asset or liability if the asset is less than 12 months or equals to 12 months and there is no purchase option, or the underlying asset has low value, e.g., laptop printers. I don't know if that is clear. That's very straightforward. So, according to in my notes here, I didn't mention the value, but according to base of conclusion BC 100 of IFRS 16, if I quote from my head, it states that if the asset is what they give us an amount, child accountant, please tell us the amount. I don't want to mention it. I believe you people should know the amount. I mean, please tell me the amount. Hello. There's an amount that they recognize as underlying assets as if it has low value that they gave us as a guidance. IFRS 16 gives us the guidance saying if it's a low value asset, what is the value they give us? Okay, if it's $5,000, that's the value they give us. Under if you go to base of conclusion 100, so the IFRS 16 they gave us according to the IFRS they gave us the standard saying that if the asset is within $5,000, then you need to recognize the assets as what as a lease. So which means the assets now might be more than 12 months, but as a low value, which means you cannot recognize the lease. So how to account? Yes. Yes. Tell them Moses said so, yes. So, or if the lease is less than 12 months and the value is high, you cannot recognize the lease also. Do you get? So that is how that works. I think it keeps throwing that out. So accounting, how do you account for this? You treat this as what? A straight line over the lease term. You just, for example, if you have 1,002 per year for a 12-month copier lease, that's photocopy lease, you just recognize 100 naira monthly expense into what? Your liability, into your P&L. What do you do? Every month you do what? Mr. Opele, give me the accounting entry. Remember that there is no asset. We're not recognizing any asset. To It's all going to be. You the accounting entry, debit and credit. And credit what? Credit what? Where are you crediting in assets? Where? You're not crediting lease. You're crediting bank or cash because you're paying that money every month. Except if, except if you've paid that money in advance, then you can go and recognize a prepayment, right? Let me show you what I'm talking about. See, if you have 1, 2, eh, and you've paid in advance, paid in advance, right? And it is 12 months, mm, right? You recognize what? 100 naira every month, monthly. So what you then do is you do what? Debit what? Debit expense, then credit what? Because you've paid in advance, you credit what? No. You credit what? No. Can you tell me what I'll credit? No. Can you tell me what I'll credit? No. Because I said it's 12 months. Don't forget. What am I crediting? You're crediting prepayment. You guys should think accountants now. If you make payment in advance, you are crediting the prepayment because I'll have recognized initially, I'll have recognized 1, 2, I'll have done debit prepayment, right? Because I paid in advance. I'll have done credit to what? I'll have credited cash at that point, isn't it? Isn't it? I'll have done debit prepayment, credit cash at that point. So which means I'm not dealing with cash again. I'll still cash for prepayment. So everything now going to prepayment now. But if it was paid in arrears, what will I be doing? What will be the accounting entry? Paid in arrears, what will I do? Which means, what will I do? Tell me debit and credit here. You can tell me. Paid in arrears. So yeah, now, yeah, yeah, yeah. Let's move quickly. I have a lot to show you. I just want to show you a lot of things. Hmm. You are correct, but then I have issues with it. You are correct, but I have issues with it. You know why I have issues with it? When do you recognize Accra? Define Accra for me. What I used to say people in interview in what's it called? In let me so at what time will I post in Accra and will I post in creditor? What's the difference between Accra and creditor? Difference, Accra and creditor, what's the difference? You can see that you've implicated yourself because you told me that Accra is people that you are owing that you've not paid, expenses you've made, you've enjoyed, service you've enjoyed but you've not paid, and you told me, and because that is also the same thing for creditor. So tell me, why would I not have an Accra and creditor? Why wouldn't I just have creditor alone? Why would I just have Accra alone? You can see that you have implicated yourself by saying that. So Accra is service enjoyed that you've not been invoiced for, not paid. Don't use the word paid. Enjoyed but not invoiced, not invoiced for. Then while it is service enjoyed but invoiced for. The only reason why, if I'm doing an audit and I see an Accra, I want to ask them, Why is this Accra here? Blah, blah, blah. I say, I just struck it out. That's why most time you see Accras of for auditors, 100,000. I just look at when auditors go there and see the accountants Accras, we just track it off. Like, this doesn't qualify as an Accra because why? In our brain, we are thinking, is there an invoice for this? The moment you have an invoice for it before year end, then it's no longer an Accra. Do you get? It becomes a creditor. So you have to move within Accra to creditor. So that you can see there's all this movement within debit Accra, credit creditor, debit Accra, credit creditor. That's because that invoice is the big objective there. Invoice. Eh? What's the way between prepayment and accrued income? This is what I fail people on interview for. Once you don't give me this, I just say bye bye. Okay. Then what is made but service not enjoyed? Yes, correct. But service not enjoyed. Okay. Yeah. Then what about yeah, very correct. What about accrued income? Sorry, my question was this. What is between receivables and accrued income? I want to, yes. So what's the answer? What's the answer? Yeah. Okay. And you have issued the invoice. Then accrued. Okay. Cost okay, customer has paid, but service not carried out. Beautiful nonsense you guys have given me. So let me give you the answer. So receivables is services rent services services rendered by the company, hmm, with invoice issued to customer up to date of the balance. While accrued income is services rendered by the company with invoice not issued. That's not what you said. I'm an auditor. Don't forget, I everything you said, I'm thinking about them in terms of the standard. Now, what you told me was that you said that services rendered by the company. Eh? You said services paid for. That's the word you use. That's the services that they've paid them for. They paid the company for, but the company has not has done the work. Sorry, you said the services they've paid for. The company has not done the work, but they've also not issued the invoice. That's what you said, which is wrong. Which is wrong. So now let me break it down for you. When you use the word accrued income, it means that the service has been rendered, but you've not raised invoice, which is there are reasons why you've not raised invoice. One, it might be that the services cannot be quantified by the customer. For example, if I'm building a software for a client now, I cannot, and the software has not been delivered to the client, and we don't have an agreement that I'll be paying, and the client is going to pay so amount, then I cannot recognize an accrued income. Sorry, I cannot recognize an invoice. I can't raise an invoice to the client until when that job is completely done. Do you get? So in such situation, I can only recognize an accrued income in my book, which is just for my book alone, because I'm doing the Accra accounting concept. Do you get? So when the invoice is not raised, then it is called an accrued income or WIP, work in progress. So you then have what is called a services rendered by the company, but that service cannot be quantified because you are just working. Your customer doesn't know you've done those job because they cannot know because you've not fulfilled the terms of your contract. But if you are saying that accrued income is services that have been done by the company, right? That they've been paid for. No, it is wrong. That word paid for is wrong. Do you get? The moment they pay for that service, that goes towards deferred income. Hmm? Do you get? It goes to deferred income once they've paid them. Then once it goes to deferred income, they cannot be saying, okay, deferred income. Then why would you be recognizing accrued income with deferred income? Because if they've paid this a deferred income, if I teach you this, it's complex, so your head will be turning. No. Now, okay, now Okay, now if you go to deferred income, now let's assume now a customer pay, we are deviating from lease. That's not how to teach. Okay, let's just go into it. I don't want to talk about it too much, but let me just go into it. Now, let's say a customer paid 10,000 naira to do a job in advance. Now, what do? You recognize what? Credits what? Credits what? Deferred income, right? Am I correct? And then what am I going to debit? Oh, yeah. Thank you very much. Yes. Bank or cash, anyone. So now this is already the first initial treatment, right? Now, as I'm doing the job for the customer, if I can deliver the job to the customer as I'm doing the job, I'll be delivering the job. Let's say the job is in 3 stages. I'll give you two example. Example one, in 3 stages delivery. Delivered based on IFRS 15. So you get delivered. You can see how the standard they all work, they all interwove, they're interwoven. Delivered once completed. Do you get? Eh? You can see that the standards are all interwoven. You can see once completed. Now for this 3 stage delivery, what will I do? At every point in time when I want to deliver, what I'm going to be doing is I'm going to be saying, I'll come here and say income, receivables, then what else am I going to do? Deferred income. What other account do I need again? Accrued income. Those are my accounts I need to post into. So now, stage one level has been done at the end of the month, right? I'm going to do, and stage one is, let's say, £3,000. I say 3,000. I'm going to do what? Give me the accounting entry. Give me accounting entry before accrued income. What am I doing? What am I doing? Should I do it or should you guys want to tell me? Should I go in and do it? Hmm? Oh, yeah, nah. Answer nah. Eh? Debits accrued income 3,000. You now credit income 3,000, right? I'll explain to you. Don't worry. What I've been doing now. Then, once I've done that, I want to recognize it and I go and say what credit receivable. Sorry, I'll not say I'll not no I can't debit receivable like that. Don't forget, sorry, receivable cannot come in because I've already received the money. Don't forget. So you get what I have here is accrued income again. I know it's confusing, don't worry. I'll now do what? Credit accrued income. Hmm? Hmm? Credit accrued income 3,000. And then what? Debit what? Deferred income with 3,000. Credit, debit. I mean, do you understand? I should explain. Thank you. Now let me explain to you. In every company, when you're having accrued income, when you're having a job to deliver at its stages, you cannot recognize the amount as your income initially when you're doing that work. So at once you've done the stage, which you are sure that that stage is quantifiable enough, and you can receive money for that stage, and you're sure that that stage you've done can be accounted for. You guys know what you spent, everything you've done up to that stage, then you cannot recognize what's called an accrued income. It is always recognized in two ways. One, either at the end of the year or at the end of the month. If you look at every company, every damn company in this whole world, they recognize accrued income either at the end of the year or at the end of the month or at the end of the period, maybe a quarter, when they agree to always recognize that income. Then when you recognize that income in a quarter, you still have to divide it by 3 because we want to know for management account purpose to know which amounts we have made in the month in accrual concept of accounting. Don't forget, accrual concept of accounting is what? Concept is when what? Income is earned when not when cash is received, right? Thank you very much. So now you now do what? Debit accrued income for that month, for the month of let's say January. Eh? Then you now credit income. You now say being accrued income for blah 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 for the month of what? January. Then in the following month, when we get to February, this is what someone in EY does not understand though in Dubai that I had to explain to her with my life. I explained to her in Dubai, the lady in Dubai UI. Sorry, I'm recording this thing. So now, after debiting accrued income, We will now reverse that transaction at the in the next month. In February, we'll now say debit income, credit accrued income, which is what I've done. Yeah. I'll tell you why I didn't do that here. Oh. I'm coming to tell you that now. So 3,000 debits to income, then 3,000 credit to accrued income. Is going to be what? Reversal of January income, accrued income. Do you know why we did that? Yes. Yes. Mm-hmm. See, at the end of January, you have what is called a WIP, a work in progress. It's a complex situation. You know what? I don't know what I explained it to someone in, like I mentioned, a manager. She does not understand it even up to there. I'm not sure she still understand it. Even the guy they brought also from the UK here to come and physically check what I've done, the guy too does not understand it. So I had to explain, and I got tired of explaining to them, and I left them alone. So now, and the guy is a senior. So accrued income WIP has to be debited at the end of the month in a crack concept of accounting. When, for example, if I do a job with you, a company, January 1, I spend 2,000 naira, I write it down in my book. January 2, I spend 5,000 naira, I write it down in my book. At the end of January, I must have spent, let's say, 3,000 naira. That 3,000 naira, I have to now go and debit at the end of January. I have to go and debit since I can quantify the figure. Or debit my accrued income work in progress. Because that money is for my customer that I'm working for. Do you get? So the money becomes an asset to me. Yes, because I've not issued invoice. It cannot be receivables. Do you get? Yes, yes, you got it. So I'll now debit accrued income WIP of 3,000. I'll go and credit income because of a crack of account. Don't forget that that is an income for me for that month because don't forget that if I spend 2,005 on the cost, I'll consider what is that element of income cost in the total income. What stage is that? That stage might be 25% or 30% of the transaction. I'll now say, since 30%, I'll now say equals 25 divided by what? Sorry, I'll now say what? I'll say this what multiplied by what? By what? 10,000. Do you guess what I've done? Eh? Because this 25 I've spent now, we've agreed that it's 30% of that job we've done. Because don't forget, we have element of profit in it. So you get. So I'm not going to recognize 3,000 in what? In my income. And now recognize my accrued income 3,000. So accrued income now be what? Accrued income will be equals 25 plus element of profit recognized, which is 3,000. Then income will now have 3,000. Then at the end of then in February 1, it has to be February 1, no. It comes February 2nd, though. February 1, I have to reverse it back by debiting income and crediting what? Accrued income. Sorry, hold on. Am I supposed to credit accrued income? Yes, exactly. In February again, I'll do the same thing again. I'll credit again 3,000. I'm not going to credit 6,000. No, I'm going to credit that same figure 3,000 and debit. Then the moment I raise invoice, then it goes to receivables. If I've not been paid for that job, or because I've been paid, that's why it's going to deferred income. Do you know now I'm going to debit deferred income? Normally I could have debit receivables. Do you know? But because I've received that cash before, so I have to go and eat what? I have to go and eat my deferred income because deferred income has already been done with credit deferred income 10,000 debit bank. So therefore, normally I should have been saying that, oh, now I'm now going to reduce this. I'm going to reduce this 10,000 by saying what? By eating it, by saying minus 3,000 now. Do you get? And I have 7K. The following period again, minus 3,000 again. So you get. Then the last one might be minus 4,000. Do you get? Eh? And all of this will have to go to what? Will go to my income. That's what I've showed you here. Credit income, debit accrued income, reverse it back, credit accrued income, debit deferred income. One posting seems to be yes, yes. The posting is correct, it's complete here. It's complete here. So I don't know if that is clear. now. So what are you putting accrued income again when you already recognize as deferred income and income has been recognized already? You have deferred income has been reduced and income has been recognized also. Then there's nothing to recognize again. Do you get to stay in what? Yes, yes, it's going to be balance sheet. But yes, because we can call no, it will be called accrued income work in progress. That's what we call it. Accrued income WIP. Yes. Yes. Because you might have other receivables that you don't want to lump up. Because you might have other receivables. For example, now I might have other things like I might loan my staff money in the company. Do you know it is exactly? I'm not. Thank God. Thank you. Thank you. Thank you. You are a tax person. Exactly. That is why we have to. Exactly. You got the point. That is why we need to recognize accrued income WIP for the purpose of tax. Otherwise, you'll be paying tax that you should not be paying. Exactly. Exactly. That's why you need to recognize that accrued income WIP because you can't be paying tax for what you've not enjoyed. Okay, so I can move on. So leases must disclose depreciation of right of use assets, interest expense. And when I start doing that practical work, I'm not going to record it because I cannot record it when I'm start doing practical work. I won't record it. So you guys have to be in class, please. So um because I don't want to record it because it's the work I did for a client in outside of UK. So depreciation of right of use assets, interest expense on lease liability, then expense for short-term or low-value lease, cash outflow for leases, addition of this must be disclosed. All those things must be disclosed in the lease. I'm going to show you my disclosures on those things when I go in them. Don't worry. Can you guys can read this now? Difference between IS 17 and IFRS 16. Like we said, IS 17 is the old one, while the IFRS 16 is the new one. IFRS 17 has two models, finance and operating lease, but IFRS 16 now has a single model, which is right of use and liability. Balance sheet item before we used to have operating lease, which will always go in off balance sheet item if it's operating lease, but now all leases are supposed to be on balance sheet except the exempt ones, which I mentioned, which is low value asset of 5,000 or 12 months or less than. Do you get has to go to off balance sheet item? Then P&L effect, lease expense before a straight line, but here you have depreciation plus interest. There's now improved consistency. Like before that, people were doing rubbish that they like on IS 17. So lease, finance lease, recognize assets, recognize blah blah blah. Now this is the last example. Let me just show you this example. So accounting for lease, I'm giving you an example now that if the cost of assets is 100,000 naira and the fair value is 100,000 naira and the lease term is 3 years and the annual lease payment is 40,000 paid at year end. Can you see those things are important to pay that year end or pay at the beginning of the month? You must know those things, otherwise your lease is going to be wrong. You have a wrong discount, have a wrong present value if you don't know to those things rightly. So, and I'm going to show you how you're going to know those things. So, interest rates implicit is 8%. Useful life is what? Useful life is what is 5 years. Step one, how to determine the lease as a leasee. The step one is that determine the lease type first. The lease term is 3 years. It covers the majority part of of the asset of the life of the asset, which is 5 years. Then also look at the present value of the lease payment. It's almost equal to 100,000. The lease transfers substantially all risk and reward to the leasing. So therefore, it is a finance lease. That's how to determine a finance lease. You first look at the lease year. The total life of the asset is 5 years, and the lease is just 3 years. So therefore, we can assume that it is going to be a finance lease because you've used major part of the lease of the lease life, which is about 60 something percent of the lease life. Then also the present value of the lease payment is 120,000 or so, and you're already using I think 103,000 or so. And you're already using 100,000 of the lease life. What is 3,000 left? It makes no sense. So it is already a finance lease. That's what it means. Then the lease transfers substantially all risk and reward to the leasee, which means the lessor is not holding back anything from the lease. So therefore, the lease is what is a finance lease. So let's go to calculation of it. So So XYZ Limited leases equipment for 100,000. Useful life is 5 years, and you're paying 3 years. You're paying 40,000 every year to them. So per annum, the fair value is 100,000. Basically, interest rate is implicit of 8%. I've just showed you calculation of the fair value, which is the PV is 40,000 times 1 minus 1 brackets 1 plus R raised to power minus n number of years divided by what? Divided by the DC, by the discount factor. That's the discount rate, which is the DCF of 8%. So if you do that, you're going to get what? 103,000. So you can see the lease life already is 5 years. The lease life is 3 years, but the asset has a useful life of 5 years. So you've used majorly part of the assets, major part of the asset life. Then the cost of the asset is what? Is 103,000 in terms of the prayer value. Already the cost of asset is 100,000. So which means it is a finance lease. You have used all of those lease. So therefore, the journal entry to go into the book of the lessor is going to be what? Debit net investment in lease and then credit equipment. That is for the lessor now and not you, the lease. That is what I'm doing now is the lessor accounting of lease, not the lease accounting of lease. I hope we are on the same track. I hope you're on the same track. Hmm? What I'm doing is the lessor accounting for lease and not the lease accounting for lease. Are we clear? Hmm? Okay. It's for I'm accounting for the lessor and not the lessee now. That is the lessor is the person who owns the assets. Yes. So the lessor, because it's a finance lease, the lessor has to recognize what an investment in lease of 100,000 and then create equipment of assets which is 100,000 for that. Then the lessor then does this every year. The lessor then does what? The lessor does the income yearly. Says opening balance of 100,000, you can see interest is 8%. That's the interest, that's 8,000 naira. Then payment is 40,000 every year. Closing balance is going to be equal 68K. I'm going to show you all of this in my Excel. So, which what we've done is basically closing balance, because we've done 100K minus payment minus what? Interest rates. Do you get? Sorry, 100K plus interest rates minus, don't forget that the opening balance is the lease liability. Don't forget, you get in the book of the lessee. While in the book of the lessor, it is what? It is the investment. So 100K plus 8,000 minus 40K, K. 68K is going to come forward as the opening balance. Then you now say 58K plus the interest rate becomes 5440. Then minus 40,000 becomes 33,440. 33,440 plus the interest rate of that 8% of this amount, that's 8% of this figure would then become what? Would then become 40,000 what? 30 something K. That's 30 what? 35K. Then you are paying so you're paying 40K, that's about 4K is left as a residual figure. So what you then do is you then do total interest income is 8,000 plus 5,000 plus 22,000. Which one? Yes, there's a residual figure, but I think for some reason that thing wasn't recognized fully. So the residual figure is supposed to be like about 3,000 something as residual figure, because sometimes in lease anyway, if you don't do the lease calculation, maybe in terms of the payment in advance or payment in arrears properly, you will always have a residual figure at the end of your lease. I'm going to show it to you in my Excel when I go to the Excel calculation. Yeah. So interest on on total interest on the lease is going to be 16,000 for the 3 years, which is shown here, 8,000, 5,000, and 2,000, which is 16,000. Then what the lessor then do, the lessor does what? Debit was lease receivables, interest income for 8,000, and then debit cash for 40,000. Then credit investments lease, which is 40,000, then credit finance income, which is 8,000. Then while the while the lessee, on the other hand, will then recognize what is called right of use of the asset of 100,000 and the lease liability of 100,000. Don't forget, based on the present value we did backward and the thing I've explained before. So the lessee recognizes a right of use asset of 100,000 and then the liability of 100,000. And they also recognize depreciation and interest expense, which I'll be showing you in my Excel as we go on. And that's it. Let's go to the Excel now. Recording now.